Of the many accounting standards which are there in your ACCA SBR exam, one of them is IAS 41. Now, this is not a standard that is particularly tough, neither is this a standard which consumes a lot of time in your preparation. But a lot of this has already been built at the skill level, which is why chances of full-fledged independent questions coming from IAS 41 are rare. But there is a possibility that a 4 to 6 marks apart on rare occasions can be tested in one of the section B questions. Hence, it is necessary that we pay adequate attention to this standard. This standard, in a lot of ways, takes off from where IAS 41 also left. Now, it's you have to understand that IAS 2 and IAS 41, parts of them are related. Back in the day when I was studying to be a chartered accountant, and I'm talking about 2013, 2011, those years, there was no separate standard on agriculture that we studied in India. But now, of course, there is a full-fledged standard, IAS 41, which talks about agriculture. So let's understand IAS 41. IAS 41 agriculture applies to biological assets and to agricultural produce at the time of harvest. Agricultural produce at the time of harvest. Say, for example, there is a mango tree and they are ready. They have ripened on the tree and now you are going to pluck them off. So when you are plucking them off at that point, that is agricultural produce at the time of harvest, that is covered by IAS 41. And a biological asset is a living plant or an animal. So the mango tree itself is a biological asset. A cow in your farm or the goat in your farm is a biological asset. But the milk that is, drawn or milked from the cow or the buffalo or the goat is agricultural produce. Similarly, the fruits which are plucked from the tree are also a part of the agricultural produce. It is harvested product of the entity's biological assets. So what does the biological asset create? The biological asset creates an output. Like from a cow, you will get milk. From a mango tree, you will get mangoes. That is your agricultural produce. Harvest is the detachment of produce from a biological asset or the cessation of a biological asset's life process. Now, even think of a wheat paddy, think of a rice paddy field, or think of a wheat field, or think of any field for that matter. There is the physical act of cutting the physical produce, cutting the agricultural produce from the tree and putting it separately. Okay, there is an act of cutting it from the tree and putting it separately. That is your agriculture. So that is the act of harvest where you are cutting it off. At that point, it is agricultural produce. And the moment you put it, you ship it to the warehouse, you put it in the warehouse, that becomes your inventory. So a farmer buys a calf. That calf is a biological asset. That calf grows into a full cow. That growth is a biological transformation. And then the farmer milks the cow. That milk is agricultural produce. And later on, when that milk is pasteurized and that milk is stored in cans and containers, that becomes inventory. So for biological assets, that is animals on the farm and trees and all of those things, what is the recognition criteria? A biological asset should be recognized if it is probable that future economic benefits will flow to the entity, the cost or fair value of the asset can be reliably measured, and the entity controls the asset. Just think about it. Biological asset. So it behaves very much, like any other non-current asset for that matter. Now, when would you say that, or when would you recognize a non-current asset? When it is probable that future economic benefits will be received from that particular asset. So that basically is your same recognition criteria applies to IAS 41. When it is probable, that is chance of happening is greater than chance of not happening, that this particular cow is going to give me future economic benefits, or this particular tree is going to give me future economic benefits. The cost or the fair value can be reliably measured and the entity controls the asset. The control criteria is there in tangible, intangible, all kinds of assets. If all these conditions are fulfilled, then you can say that this particular asset can be recognized in your books of accounts. The word recognize primarily means, or what question does the word recognition answer? The word recognition tells me when exactly to record the accounting entry. That is what revenue recognition also was all about, right? When do I record the accounting entry? Recognition basically answers the question when. So when do you record a biological asset? You record a biological asset when it is probable that future economic benefits on account of that asset flow to the entity, the cost or the fair value can be reliably measured, and the entity controls that particular asset. Initial recognition. Biological assets are initially recognized at fair value less estimated cost to sell. Okay. Biological assets are initially measured at fair value less estimated cost to sell. Now, if you cast your mind back to all the other accounting standards, the other accounting standards being IAS 16, IAS 38, IAS 40, any of these asset related standards, you will realize that most of the assets are initially recognized at cost. Okay, property, plant, and equipment is recognized at cost. Your investment property is recognized at cost. Everything is recognized at cost except for biological assets. Biological assets are initially measured at fair value less cost to sell. Apart from this, the only other place that you have in your syllabus where initial recognition happens at fair value on the asset side is for financial instruments, financial assets, and also in case of financial liabilities also in a modified form, but not anywhere else. And gains and losses on that may arise are recognized in P&L. Say, for example, I have a cow and the cow gives birth to a calf. On the date the calf is born, the fair value of the calf in the market is 40,000. A newborn calf is sold for 40,000. Okay, so when a cow on my farm gives birth to a calf, that calf is a new biological asset. I did not spend any cost in building it. It took birth just now. So at what value I will recognize? I will recognize this at fair value. And what is the accounting entry? Calf account debit, which is an asset. So debit calf account, and what will get credited? Profit and loss account will get credited. So that is your accounting entry. Okay. Now, subsequent measurement. Okay, but before we go into subsequent measurement, I hope initial recognition is clear to everyone. And just a small distinction between biological asset, agricultural produce, and inventory. The cattle on my farm is biological asset. The milk that I get from the cattle is my agricultural produce. And when this milk is heated and pasteurized and stored in cans or cheese, that is my inventory. Okay, rubber trees are my biological asset, and the rubber product that I get from it, the rubber that I get from it is my inventory. The mango tree is my agricultural. So the mango tree is my biological asset. The mangoes I have plucked, those plucked mangoes are agricultural produce. And what is my inventory? From that mango, if I make some mango jam or I make or I put those mangoes in my warehouse, that becomes my inventory. The tea bushes in Darjeeling field, those are my biological asset. The plucked tea leaves are my agricultural produce, and then I crush it and I dry it, and then whatever tea I have, that is my inventory. So this is how the distinction goes between biological assets, agricultural produce, and inventory. Okay, now at each reporting date, biological assets are revalued to fair value less cost to sell. Gains and losses arising from changes in fair value are recognized in profit or loss for the period in which they arise. Say, for example, reporting date is 31st of March. By this date, the calf has grown up, its value has also increased. Now it is worth 65,000 and cost to sell in the market would be 2,500. So fair value less cost to sell would be 65,000 minus 2,500. I would get 62,500. How is the subsequent measurement done at each reporting date? Fair value less cost to sell. The calf, when it was born, the market value of one calf was 40,000. I recorded that at the fair value. Calf account debit to profit and loss account, because that is a gain for my business. And on the date of initial recognition, the calf was recorded at a fair value of 40,000. On the balance sheet date, fair value less cost to sell is 62,500. Okay. On the balance sheet date, uh, my fair value less cost to sell is 40,000 plus 20, so 65,000 is my fair value. Cost to sell is 2,500. So fair value less cost to sell is 62,500. I have to revalue this asset in my books of accounts. Debit the biological asset, credit P&L account. Okay. The initial at the time of initial recognition also, whatever gain was, whatever gain you had, that was also credited to P&L. The fair value of a biological asset may change because of its age or because prices in the market have changed. IAS 41 recommends separate disclosure of physical and price changes because this information is likely to be of interest to users of financial statements. However, this is not mandatory. Now, think about, if I am running a dairy farm and the milk produce is the main business. And where does the milk come from? It comes from my cattle. So the age of the cattle, the physical condition of the cattle would be very important to determine how much milk would continue to get produced in the future. And for that purpose, it is very important that this information is also communicated to the users of financial statements. They would know that as the cow gets older, or as it advances in age, maybe its milk generation capacity would go down. So it is not mandatory, but this is information that would aid the users of financial statements. Biological assets are presented separately on the face of the statement of financial position within non-current assets. The inability to measure fair value, say for example, on the balance sheet date, you are not able to measure fair value. Basic presumption is that in most cases, you would be capable of measuring the fair value reliably. But if market prices are not readily available, then the biological asset should be measured at cost, less accumulated depreciation and accumulated impairment losses, just like you would present any other tangible non-current asset. These are rare circumstances because in most cases, market values would be readily available. And once the asset's fair value can be measured reliably, it should be remeasured to fair value less cost to sell. The cost minus accumulated depreciation minus accumulated impairment loss is a calculation that has to be performed only in the case that fair value is not readily available. It's not something that you will do on a recurring basis. Okay, now understand how to tackle agricultural produce. Agricultural produce is also measured at fair value when harvested. Okay, that is agricultural produce. Agricultural produce is measured at fair value when harvested. I have mango trees in my orchard. In the harvest season, 1,000 mangoes that have grown on the tree, they are plucked. Okay, when the mangoes are plucked, it is agricultural produce at the time of harvest. Okay, now I took care of the tree. I watered the tree. I put fertilizers, pesticides, everything, whatever. And the mangoes have grown. I have not specifically spent money on growing the mangoes. The way I would spend money on purchasing a chair, I have not spent money on purchasing a mango. It has grown on the tree. Okay. So that mango, however, although I did not pay anything for that mango, that is an asset for me because I'm going to sell it and make money from that. So when I pluck the mango at that particular time, I will record it at the fair value at the time it is plucked. So if the fair value of a mango is 50 at the time of plucking, some categories of Alfonso could very well fetch more than that. So what is the fair value at the time of harvesting? I pluck the mango, I put it in my box. Okay, I pluck the mango, I put it in my box. There are 1,000 mangoes, 1,000 into 50, that is 50,000. Now, what is the accounting entry? Mangoes, that is agricultural produce account, debit to profit and loss account. Okay, mangoes, that is agricultural produce, it is a current asset. Mangoes account, debit to P&L. Why P&L? Because when I got these mangoes, that was a gain for me. I did not spend anything on making the mango. I got that from the tree itself, and that is like a gain for me. So mangoes account, debit to profit and loss account. After the mangoes are plucked, they are transferred to a godown. Now the same mangoes become inventory. The moment I pluck them, at that time, I have to bring those mangoes into my books of accounts. At that time, I have to use fair value. So I record the entry mangoes account debit to profit and loss account. And after the mangoes are plucked and they are transferred to a godown, that becomes inventory. That so what will be the accounting entry now? From this agricultural produce, it will get transferred to inventory. So mangoes, inventory account debit to mangoes, agricultural produce. So agricultural produce is only for bringing it into books of accounts. Once you bring it into books of accounts, then that becomes your inventory. Okay, so the moment at the time of plucking it is agricultural produce. The moment you transfer it to your godown or you put it in a separate bag, that becomes your inventory. So inventory account gets debited and agricultural produce gets credited. Agricultural produce is at zero. Okay. Suppose I milk the cows and get 500 liters of milk. This is agricultural produce. The fair value of raw milk is 100 per liter. Again, I did not buy the milk. I got the milk from my cows. I have to bring this new thing into my books of accounts. So by milk, agricultural produce account debit to P&L account. Okay. And raw milk cannot be stored or consumed. So, and you are not even supposed to consume it directly. So it is subjected to a process called pasteurization, without which milk cannot be consumed or stored or sold. Now, this process costs me 5,000, heating, sealing, and all of that. For sealing it in storage containers, I spend around 2,000. And this process is also necessary as I cannot keep my milk loose. If I keep my milk like that, the milk will get spoiled. So what I do is I have to do processing. I have to heat it before I can use it. Okay, I might have to add some preservatives here. So processing charges account debit. Storage charges account debit because I'm spending it for, putting it into containers, sealing it and all of that to bank account. Now, usually all expenses, what happens? All expenses will go to P&L. But think about it. Unless the processing happens, the milk cannot be stored. And unless the milk is stored in containers, you cannot put it in the godown. So it will not come in a position where sale becomes possible. For bringing the milk to a condition where sale becomes possible, it is quite important that you incur the processing charges also and you incur the uh, storage charges also, and you pay for heating, wetting, wo sab you will have to incur. So all of these are costs which are necessary to bring the asset to its current location and working condition. So these will get added to the cost of inventory. So milk inventory account debit 57,000. To milk agricultural produce account credit. Agricultural produce was recorded at 50. Now I am crediting agricultural produce. Then processing charges account credit 5,000. To storage process 2,000. Now, instead of transferring these two expenses to P&L, I added them to the cost of inventory. Processing charges bhi add ho gaya. Storage process charges bhi add ho gaya. 57,000 is now the cost of inventory. At the year end, if some part of this is unsold, it would be valued at lower of cost or net realizable value. Example 2 here traces the entire journey of this item from agricultural produce to inventory and how the valuation is done and how the accounting is done. Now, as ACCA members, ACCA students, it is important that you understand not just the financial reporting implications, but how does the journey of that particular item take place. So later, when you have to work on, any of these specific items in your work profile, you will have a complete idea. So look at example 2. Very important for you. Okay. Now, before we move ahead into understanding the certain questions on IAS 41, it's important to understand the scope. Where all does this accounting standard apply? IAS 41 does not apply to intangible assets like production quotas. It does not apply to bearer plants. What is the bearer plant? We'll see. Don't worry. And it also does not apply to land related to agricultural activity. In accordance with IAS 38, these production quotas are accounted for at cost less amortization on that particular date. What are bearer plants? Bearer plants are used to produce agricultural produce for more than one period. Grapevine or tea bushes, these are bearer plants, or the mango tree is a bearer plant. Bearer plants are accounted for in accordance with IAS 16 property, plant and equipment. However, any unharvested produce growing on a bearer plant, such as grapes on a grapevine, is a biological asset and so is accounted for in accordance with IAS 41. And uh, if you are, say, looking at the mango tree, it is a bearer plant. It has to be accounted for using IAS 16. Land is not a biological asset. It is a tangible non-current asset. It should be accounted for using IAS 16 property, plant and equipment. Okay. Mango tree is the bearer plant. Mangoes, as long as they are attached to the tree, IAS 41. At the time they are plucked from the tree, IAS 41. Agricultural produce at the time of harvest. After they are plucked and separated from the tree, that becomes your inventory. Okay, now let's have a look at one question from this topic. Discuss the accounting treatment of the above in the financial statements for the year ended 31st of December 2001. On 1st of Jan 2001, a farmer had a herd of 100 cows, all of which were 2 years old. Okay. So, existing herd. Okay. Number of cows, 100 cows. Okay. Age of the cows, 2 years. Okay. At this date, the fair value less point of sale cost of the herd was 10,000. So, existing herd on 1st of Jan 2001. Age of the cows is 2 years. Okay. Fair value less cost to sell. How much is that? It is $10,000. Okay. On 1st of July 2001, what happens? The farmer purchased some 20 new cows, each 2.5 years old. Okay. So let's talk about new cows purchased. When? 1st of July 2001. What is the number of cows purchased? Some 20 cows were purchased. Okay. What is the age of the cows? 2.5 years. Age of the cows on 1st of July 2001. Okay. 2.5 years. And on 1st of July 2001, the farmer purchased 20 cows for $60 each. So, purchase price of each cow, $60. So, total purchase price is 20 into 60. How much will that be? That will be around 2000. Sorry, 1200. Okay. At 31st of December, 3-year-old cows sell at market for $90 each. And the market auctioneers, what do they do? The market auctioneers charged a levy of 2% for many years. Okay. So, see, on 1st of Jan 2001, the age of the cows was 2 years. And cows from existing herd will be 3 years old on 31st of December 2001. Okay. Cows from the existing herd will be 3-year-old. And at 31st of December, 3-year-old cows sell at market for $90 each. And marketeers have charged a sales levy of 2% for many years. So, on 31st of December 2001, fair value less cost to sell would be how much? It would be 90 fair value less 2% sales levy. कितना होगा? 90 minus 2% of 90, 88.2. $88.2. This is the price. This is the fair value less cost to sell of one cow on 31st of December 2001. How is the item valued? The item should be valued at fair value less cost to sell. That is how the subsequent measurement is done. So, what is the value of 100 cows? 100 into 88.20. कितना होगा? This will be $8820. ठीक है. These cows were initially in the books of accounts at 10,000. On the balance sheet date, the value is 8820. So there is a decline in the fair value. What will be the accounting entry? Accounting entry will be by profit and loss account debit to cows. And what are these cows? These are biological asset for me. P&L account debit to cows. That is, the value of cows were my asset. These cows were in my books of accounts at 10,000. Now the fair value less cost to sell on 31st of December was 8820. So 10,000 minus 8820, 1180 is the amount at which you should record the accounting entry. Okay. Now this is one part. So this is how you handle the existing herd. Okay. Now let's talk about the new cows. The new cows were purchased for 1200. And new cows were purchased for 1200. And these new cows will also be 3 years old on 31st of December 2001. Okay. And on 31st of December 2001, fair value less cost to sell kitna hai? Fair value less cost to sell is 88.2. Okay. Fair value less cost to sell is 88.2. So what is the value of 20 cows? It is 20 into 88.20. है ना? 20 into 88.20, 1764. $1764. Now these assets, these cows are already there in your books of accounts at what value? At 1200. And on the balance sheet date, fair value less cost to sell is 1764. So what would be the accounting entry for this? The accounting entry would be, the entry would be reversed. Here the entry would be by cows biological asset account debit to profit and loss. There is an increase in fair value, and any change in fair value gets routed through P&L. So 1764 minus 1200, 564. If you so want, you can net it off and put the net value in your books of accounts. ठीक है, net off करके भी you can put the entry, but this is how the existing herd will be tackled, revalued at fair value less cost to sell. This is how the new cows will also be tackled, valued at fair value less cost to sell. Okay, you can net off the two entries. That is also equally acceptable, no problem. Let's have a look at one more question, which is on, again, on IAS 41 only. Goodwine is a company that grows and harvests grapes. Grapevines, which produces a new harvest of grapes each year, are typically replaced every 30 years. ठीक है, that plant. Harvested grapes are sold to wine producers. With regards to property, plant, and equipment, good wine accounts for land using the revaluation model and all other classes of assets using the cost model, which is okay. On 30th of June, its grapevines had a carrying amount of 3 lakh and a remaining useful life of 20 years. The grapes on the vines, which are generally harvested in August each year, had a fair value of 5 lakh. The land used for growing the grapevines had a fair value of 2 million. On 30th June 2002, grapes with a fair value of 1 million were harvested early due to unusual weather conditions. The grapes left on the grapevines had a fair value of 5,20,000. The land had a fair value of 2.1 million. All selling costs are negligible and should be ignored. Discuss the accounting treatment of the above in the financial statements. Now, this is a detailed question because it has multiple items. There is land. First of all, land is basically IAS 16. Okay, so here your attention is localized in one part. On 30th of June, land had a fair value of how much? Land had a fair value of 2 million, and on 30th of June 2002, it had a fair value of 2.1 million. Okay, so fair value on 30th of June 2001 is how much? 2 million. And what is the fair value of land on 30th of June 2002? The fair value of land on 30th of June 2002 was 2.1 million. Sorry, 2.1. Okay, so this is the fair value. For land, IAS 41 is not applicable. So you do a simple revaluation entry for this by land account debit. With respect to property, plant, and equipment, Goodwine accounts for land using the revaluation model. So you can do the revaluation here by land account debit to revaluation surplus account. Land account debit to revaluation surplus. How much? 21 lakh minus 20,000. Nothing else to be done here. Land does not get depreciated, so no need for a depreciation entry. Let's talk about the second asset, which is my bearer plant. Bearer plant is also covered under IAS 16. Now, grapevine, which produces a new harvest of grapes each year, are typically replaced every 30 years. Harvested grapes are sold to wine producers. On 30th of June, its grapevine had a carrying amount of 3 lakh and a remaining useful life of 20 years. The grapes on the vine, which are generally harvested in August each year, had a fair value of 5 lakh. Okay. Now, what is the company doing? For everything else, the company is using the cost model. Okay. So, apart from land, the company is using the cost model for all other assets. Okay. So, bearer plants will be valued at cost less accumulated depreciation less accumulated impairment loss. Okay. So that is how bearer plants are going to be valued. Now, now let's understand how does the accounting part work. Okay. And there is another thing here. The fair value of this is fair value is given to you, by the way. Huh? They have given you that the fair value of the grapevine is how much? Grapevine is a bearer plant. Grapevines are bearer plant. Fair value on 30th of June 2001 is how much? Its grapevines had a carrying amount of 3 lakh. ठीक है, यहाँ पे कुछ फेयर वैल्यू तो लेट्स सी। फेयर वैल्यू ऑन 30th of June is 2001. Not fair value, sorry, my bad. Carrying amount on 30th of June 2001 and a remaining useful life of 20. Remaining useful life on 30th June 2001 is 20 years. So, what would be your SLM depreciation per annum? 3 lakh upon 20, 15,000. 3 lakh upon 20, that is 15,000. Now, this is the starting point. The grapes on the vine which are harvested in August each year had a fair value of 5 lakh. On 30th June 2002, grapes with a fair value of 1 lakh were harvested early due to unusual weather conditions. The grapes left on the vine had a fair value of 5 lakh 20,000. Now it's interesting what happens here. Okay. What was the original fair value of grapes on the grapevine? The original fair value of grapes was 5 lakh. Original fair value of grapes on the grapevine on 30th of June 2001 कितना है 5 lakh. ठीक है. Now out of these grapes with a fair value of 1 lakh were harvested and sold. So what is the fair value of grapes remaining on the grapevine, on that plant? जो ग्रेप्स बचा है उसका वैल्यू कितना होगा? उसका वैल्यू होगा 5 लाख माइनस 1 लाख, दैट इज 4 लाख. ओके. एंड on 30th of June they were sold, 30th of June 2002. The grapes left on the vine had a fair value of 5 lakh 20,000. What is the updated fair value of grapes left on the grapevine? 5 lakh 20,000. So what are these grapes? These grapes are, see, they are very much on the grapevine. They have not been harvested. So these grapes are my biological assets. When will they become agricultural produce? They will become agricultural produce when they are separated from the grapevine. And you should be valuing it at the fair value. तो entry क्या होगा? Entry होगा by grapes, biological asset, account, debit to profit and loss account. 5 lakh 20,000 minus 4 lakh, 1 lakh 20,000. You make sure that you now bring the fair value into picture of this particular biological asset. These are also valued at fair value less cost to sell. Now you are valuing this at 5 lakh 20,000. And then of course there will be accounting entry for the depreciation. The grapevine is a bearer plant. This 15,000 deserves a separate accounting entry for itself. And now one final part of IAS 41. How to do the accounting when you have received a government grant for biological asset. ठीक है. Check how is the biological asset accounted for. If you have used the cost model for accounting for the biological asset, apply IAS 20, which means either adjust against asset cost or use the deferred income method. This is a very simple situation that you have been using the cost model for accounting for biological assets. If you are using the cost model for accounting for biological assets, very simple. Apply IAS 20 like you usually do, adjust against cost or treat it as deferred income. Second option, fair value less cost to sell. This is the second model, fair value less cost to sell. If you have not accounted for the biological asset using the cost model, and this is more likely to happen, by the way, this is more likely to happen. What is the nature of the grant? If it is an unconditional grant and no condition to be fulfilled for receiving the grant. Okay, unconditional grant, no condition to be fulfilled for receiving the grant. In that case, grant should be credited to P&L when it becomes receivable. If it is a conditional grant, that grant will be received on the fulfillment of conditions, grant should be credited to P&L when conditions relating to grant are fulfilled. So basically, if the biological asset is accounted for using fair value less cost to sell model, ultimately the amount of grant will get credited to P&L. But where it is an unconditional grant, it will get credited to P&L when the grant becomes receivable. If it is a conditional grant, it will get credited to P&L when conditions relating to the grant are fulfilled. And with IAS 41, what disclosures is an entity supposed to do? Let's quickly write down the disclosures also. IAS 41 disclosures. CLOSURES. These are my disclosures. Okay. You need a description of each type slash group of biological assets. Second thing is methods and significant assumptions used when determining fair value. Methods and significant assumptions used while determining fair value, and reconciliation of carrying amount of biological asset at the beginning and the end of the period. Reconciliation of carrying amount of biological assets at the beginning and at the end of the period. So this is basically what you're supposed to do in terms of disclosures. This part, agriculture and government grants, this is new. This was not there in your FR exam. So make sure that you do this properly. Now, whatever exam you are writing, be it ACCA, be it Diploma IFRS, be it CA, any exam, accounting standard for agriculture remains the same. And questions from this are frequently tested. So they are not tested for a lot of marks, but they could be tested for 3 to 4 marks. So make sure that you do this properly.